In today's Private Market Pulse Snapshot, the one thing I'm focused on is the growth and state of private markets internationally. Since its inception in the late 1960s and early 70s, the alternatives market has undergone a remarkable transformation, evolving from its roots in the United States to eventually spread internationally. Today, private markets globally, excluding hedge funds, represent nearly 70,000 funds, which exceed $14 trillion in assets under management. That's about a 14-fold increase over the past 20 years. Now, importantly, the industry growth has been driven by expanding opportunities in non-U.S. markets. Indeed, Europe and Asia now account for nearly half of the global AUM. That's up from just 20% over 2 decades ago. Here are a few examples of this growth. In the UK, for example, annual private equity investments as a percentage of GDP have increased significantly, from just 0.5% of GDP in 2014 to around 2.5% recently. The share also grew somewhat in Europe, and in nominal terms, European GPs' assets under management grew rapidly and significantly. Elsewhere in Japan, private market AUM has doubled in the past 5 years, rising from $64 billion in 2018 to $128 billion in 2023. So what's driving this international growth trend, and will it continue? Well, several key factors are at play. First of all, the rapid economic growth in emerging markets in Asia has fueled wealth creation and investment opportunities. And second, supportive regulatory and corporate reforms in regions such as Europe and Japan have opened markets to both domestic and foreign investments. Importantly, over the near term, an improving global macro environment and synchronized central bank easing should create favorable conditions for private markets internationally. In the third quarter of 2024, for example, central banks implemented a total of 28 rate cuts, the most since the second quarter of 2020. And by the end of the year, we expect 80% of central banks globally to ease. That is up from roughly 40% in July. For private markets, lower interest rates in a stable macro environment could stimulate deal-making, boost exit activity, and support valuations. In fact, in Europe, during the second quarter of 2024, the anticipation of the ECB easing led to a significant rebound in deal-making. Deal-making increased 27% quarter-over-quarter sequentially, and the exit activity also rebounded, surging 90% quarter-over-quarter. 2024 is now shaping up to be the best year for private equity IPOs since 2021. In Asia, China announced a large round of stimulus measures in late September, which included rate-cutting measures, but also measures to boost M&A, such as lowering curbs on valuations. And speaking of valuations, private market valuations have increased generally across regions alongside the rebound in public markets, but some of the non-U.S. markets still remain relatively cheap. As of the second quarter of 2024, the median trailing 12-month EV to EBITDA multiple in Europe was 12.1 times compared to 13.1 in the United States. In the Asia-Pacific region, the median multiple was 10.1 times versus 13.3 in the U.S. in 2023. Given this rebound in activity and growth in private markets internationally, are private clients sufficiently allocated? Well, the answer in most cases is no. In Italy, for example, only 7% of private equity fundraising has come from individual investors, which is slightly below the European average. In Japan, investors hold roughly half of their assets in cash and deposits. And even the Japanese pension funds are still underallocated to private markets. Of the $2 trillion in public pensions, only around $42 billion, or roughly 2.1%, is allocated to alternatives, despite the current allocation limit of being around 5%. The bottom line is, we expect continued growth in private markets internationally, and there's lots of room for increased allocations in private client portfolios. And that's your one thing in private markets this week.